What we're going to do now is continue to build out our foundation and link all of this together. So you'll recall in video 1, we were looking at opportunity set. And so far in video 2, we've looked at fixed and floating regimes, the differences between them, and the advantages and disadvantages of both regimes. And our understanding of these regimes now is going to give us the ability to move on and look further into the potential opportunities and volatility in the Forex market. What we've also done by doing this is what we mentioned earlier, which was to start to really build an understanding and foundation of all things macroeconomics, all things macro. And this is going to continue to be a theme throughout the video series. As we referred to earlier, the Forex Trading Masterclass is as much a lesson in macroeconomics and international trade as it is for learning how to trade the currency markets outright or as part of a portfolio. So we'll continue to build that out and build our macroeconomic knowledge. But we can use this knowledge now for our objective of defining an opportunity set. And we're going to continue to drill further in defining what our opportunities may be. In fixed regimes, there's obviously very little volatility unless the fixed regime breaks. And that means the central authorities basically decide not to support their currency anymore, or decide in some way to leave the regime. But what we've got to do in order to continue to build out our opportunity set is we've got to understand further how the pegs actually work in practice. And this is also by default going to increase our macroeconomic knowledge. So if we ever see these things in the future where a fixed regime or peg breaks away, then we know potentially that volatility is going to occur, and we know how to deal with the situation. So we've got to understand how the pegs in the real world actually work. And you'll remember earlier from the Forex markets organized sheet that we split up our pegged regimes into X commodity and commodity pegged situations. In the commodity section, we had most or all of the GCC countries, and we had the Chinese yuan. In the X commodity pegged area, we had the Danish kroner, the Hong Kong dollar, and the Singapore dollar. And what we've done for you in the download section of video number 2, there is another spreadsheet entitled Forex Universe Tradable Complex. And in the first couple of sheets within the spreadsheet file, you're going to see tables which relate to pegged regimes. So let's go in there and open this up now. So what we have here is X commodity pegged and commodity pegged. And inside the next sheet, we have them all laid out as X commodity pegged and commodity pegged, but with what we call the upper and lower bounds of the fixed or pegged system. And on the right hand side here in column I, we also have some qualitative notes on how the pegs actually work. Now, we're not going to go through every single one of them. We don't really have time for that in a video series. But what you should do is, in your own time, go through every single one of these and really learn about them. because in the future, these pegs may change. And you should always keep this in the background. So overall, what we're going to do is basically make the statement that in fixed and pegged regimes, day to day, week to week, month to month, or over any decent time horizon, the value of the peg or the value of the exchange rate is not going to change materially. We're not going to get significant volatility out of them regularly, and therefore we can't make money consistently as traders out of these currencies. So we're going to have to disregard the vast majority, if not all, of our pegged currencies. But we're not going to be lazy and just completely ignore them. We're still going to learn about them. So in your own time, please learn about these and go through all of the qualitative statements here in column I and learn about these pegs and what they actually mean. You'll learn some different definitions, for example, the Chinese yuan being pegged to a crawling band being pegged to the US dollar, and essentially it being a hybrid situation where it's a crawling band / managed float, and there's a daily fixing at 9:15 in the morning Beijing time, and the bands and bandwidth of the pegs are managed every day. So go through all of these, learn about them, and in your own time you can begin to really understand how they work. We're just going to go back to the presentation now, and what we're going to try and move on to is where our real opportunities will exist. And our real opportunities exist in the floating situations, the floating regimes. So our opportunities as traders in the currency markets are really dictated by volatility, and the volatility is primarily in the floating regime currencies. And what we've done is we've taken the same approach as the fixed or pegged. We've, in the Forex Universe Tradable Complex spreadsheet file, got a couple of sheets in there that break down everything for you by X commodity floating and also by commodity floating. So let's go into the sheet now and we can show you how this is broken down. So we have all our floating currencies here, whether it's X commodity or commodity, and we have our two tabs here, X commodity and commodity floating. And if we go into the X commodity floating, you can see that we define by developed float, EMEA float, and Asian float. So there are no LATAM floats for X commodity. And in commodity float, we've defined by developed, EMEA, Asian, and LATAM. So now we've drilled down a further level. We've drilled down another level and said, okay, we understand the fixed Forex regimes, but we're going to understand them but not trade them over time frames that as traders we need to trade over in order to make consistent profit. The fixed regimes are not going to make us money over classic time horizons like 1 day, 1 week, 1 month, 3 months, maybe even a year, because the fixed regimes are trading in extremely tight ranges, and we don't want to be sitting here as traders for months or years on end just watching currencies doing nothing and hoping for something to happen. But we need to understand them, because when something does happen, we will be able to trade them. So let's not 100% forget them. Let's just put them to one side. And what we're trying to achieve here is to get a tradable opportunity set that allows us to consistently make money from the Forex markets. And we're trying to define this opportunity set, not just in terms of consistent volatility and consistent opportunities. We're also trying to define this opportunity set in terms of what is tradable. So what is tradable on general trading platforms, and get to a point where we have an opportunity set that's tradable for the retail environment. It's going to be obviously very difficult if you're a retail trader to take positions in the Egyptian pound. So we then even move on to the next level, which is to say, okay, we've defined our opportunity set in terms of volatility and opportunities, but now we need to break down even further what we can and can't trade. And what's tradable is what you see here in front of you, defined as X commodity pegged, X commodity floating, and commodity floating. So we have included some X commodity pegged currencies here because they are actually tradable on most decent retail brokerage trading platforms, whether that's as CFD, so contract for difference, in the United Kingdom, Europe, and Asia Pacific, or in the futures market in the US and Canada. And we've got this list for you here in the Forex Universe Tradable Complex spreadsheet in that file. And we have all the tradable instruments here. What we've also got is what's generally not tradable. So we've split that up into the X commodity floating currencies, the commodity floating, and the commodity pegged currencies. These are a universe that basically are generally not tradable on retail trading platforms. So again, download the spreadsheet, go through the process yourself, understand how we've got to this point, and you'll be able to do that in your own time. We have the tradable complex here. What we have here is the non-tradable complex, so screenshots of the spreadsheet that you have access to in the downloads area. And what this leaves us with is a situation where we can now define in an even more specific way. So we can start to define as X commodity floating majors. Now what that means is that the currency is a floating regime. It has diversity in its exports, so it's not dependent on one or two commodity prices. And it's considered a major currency by retail brokers. We have here the X commodity floating miners. So these are currencies that are available on a lot of retail brokerage trading platforms. But they're defined in our set as floating currencies, floating regime currencies that don't have significant commodity exposure and diversity in their exports, but they're considered by the retail brokerage platforms as the miners, so minor currencies. We also then split up by commodity float and commodity float majors and commodity float minors. So the commodity float majors, so majors as considered by retail brokers that are floating regimes, and the value of the currency depends very heavily on the prices of one or two international commodities. And then we have miners that are considered miners by retail brokerage platforms that are also dependent heavily on one or two commodities. So what you see in this table here is a big extension of what you might see on typical media outlets, where you get a lot of the noise perpetuated by participants with conflict of interest. We've created the big extension. We've increased our universe by defining correctly how currencies should be defined, or any asset should be defined as a trader, defined by volatility, opportunity, risk, and availability. We also have, right on the corner here, are ex-commodity pegged situations. So these currencies are generally available on retail brokerage platforms, but really we're interested in where the volatility is. We've included them just in case pegs may change, but we're really interested in what's going on over here. We had earlier the dollar majors and the major crosses as a table. That's the generally accepted table for media outlets and participants with conflict of interest in the currency markets. What we've done is now extended this, and what we've got here is a breakdown of the classifications that we've applied. So we've got ex-commodity float majors, 5 in total. Ex-commodity float minors, 4 in total. Commodity float majors, 3 in total. Commodity float minors, 8 in total. Ex-commodity pegged, 3 in total. Total opportunities equal 23, but debatable because of the commodity pegged situation. Total opportunities 23, gross net 20, and all of these currencies, in theory, can all be traded against each other. So the maximum opportunity set we've got, if we have a platform where we can trade all of these currencies, well, they can all be traded against each other, not just against the US dollar, and not just the majors traded against each other, but across the whole spectrum. So in theory, the Norwegian krona doesn't have to be just traded against the US dollar. The Norwegian krona can also be traded against the Aussie dollar. So we've also applied some qualitative analysis here, in that we're looking at potential volatility. And generally speaking, what you're going to find is that the more liquid the currency pair, the less likely volatility will occur. Because with more liquid currencies, there's more participants at any one price buying and selling. And this reduces volatility overall. It's kind of the opposite to the way retail traders think. A lot of retail traders think that it's good to go and trade the liquid currencies because they have less risk. But risk is subjective, especially if you're leveraging 100 times in that asset to try and capture volatility that doesn't really exist. So generally speaking, the more liquid the currency pair, the less likely volatility is going to occur. With more illiquid currencies, we're going to pay a wider spread and have a higher margin requirement. However, we can use less exposure to obtain higher volatility and returns. With liquid crosses, retail traders are generally forced into over-leveraging in an attempt to magnify the volatility over short time horizons. And we're talking about volatility here that might not necessarily exist. And what you're going to find in trading currencies is that the big profits can be made in currencies that you wouldn't normally expect. The big profits are the big opportunities. They come obviously with risk, but the risk can be controlled, whereas the volatility can't. The volatility just is the volatility of the asset, and that gives you either the opportunity or not to take positions and make money. big profits in trading liquid currencies can be made, especially if you're massively over leveraging. But this comes with a huge risk of hefty losses. And this is one of the main reasons why the vast majority, as in over 90% of retail traders, lose all of their money or very close to all of their money in a very short space of time. It's because they're trying to capture volatility that doesn't exist with large amounts of leverage. Now, I want you to think about this on the flip side. Volatility creates opportunities for traders. Now, if we select a very liquid, very popular currency pair to trade, and we want to trade this on a very short time frame, and there's very little volatility in the popular currency pair, that means there's less opportunity for the trader, but it also means there's less risk for the broker. And we're going to come on to this later. One of the main reasons why brokers want everybody to trade these currency pairs, the majors and the major crosses, so the dollar majors and the major crosses against each other, is because simply they're just the most liquid. And that means less risk for the broker. We'll come on to that later. But essentially, we've got a maximum opportunity set now of 506 currency pairs across this entire spectrum here. You're going to find this sheet over here. And this is the Tradable Crosses Opportunity Ranked Excel spreadsheet. We'll be looking at this later as well, when we look at the examples that we're going to use in further video modules.